Hey everyone, hopefully you're having a good day. My name's Andy. My channel is Finding Value. Today we're going to look at a couple of things, or I'm going to talk about a couple of things that some people have asked me questions about. It deals with fundamental analysis versus technical analysis. Which one's right? Which one's wrong? Um, which one do I use? Which do I prefer? And kind of what my investment style is, because I've got questions. Some people have got questions. They use certain pieces of information that, I use it, but I don't really use it. It doesn't tell you value. It just tells you price. And what ends up happening is everybody knows the price of everything, but they know the value of nothing. And it all circles back to the three pillars that I use. The three pillars that I use are the ratios to tell value, the market conditions, and I can show you what I mean by market conditions. And then technical analysis is what I use last, because the fundamentals, you need the technicals to know the fundamentals almost to some degree to validate that your fundamental analysis is right. You need to be using market data to ensure whatever you're using is actually, validated by the market. That's all that really matters. What matters is that the information that you're pulling is market information that is real time, and it's telling you that you are either right or you're wrong. Are the patterns putting in a bottoming pattern? Are the companies have lead-in patterns where people are accumulating? If they don't, then why not? And I'm using entire sectors. I'm not just using individual companies. So I think some problems that people do or they get into is they learn technical analysis. They try applying this to companies that aren't in the right market conditions. And then they get slaughtered, and then they wonder, well, this thing looked like it had some sort of lead-in pattern. It's like, well, it didn't. You didn't tie the fundamentals with the technicals. You didn't tie the technicals with the fundamentals. You didn't, you're taking one aspect and then trying to make it work. So what I do is I try to look for alignment. Alignment means that your probabilities of success drastically increase for your success. It's not 20% success rate. It goes to 80 or 90% success rate. And I'll get into what I look at and what I'm doing and kind of how I caught bottoms and how I did all of it. So let's dive in. I'll show you how I did it. And so what I did is I'm going to start with the gold to oil ratio, because that ratio is what I was using, and I was relying heavily on the gold to oil ratio. There it is. And what I was looking for in history. So let me pull up a gold to oil ratio chart on a long-term perspective. So this is macro charts. You don't need log scale on a ratio. And really what you look at is at the price of 30, so 1 ounce of gold can buy 30 barrels of oil. That's basically a topping mechanism where you get basically around 30. That is ultra cheap for oil. But what happened in this scenario here? It's an anomaly. We've never seen oil get as cheap as it did in 2020. And that was the opportunity. And it showed you through ratios saying, hey, look, oil is off the charts, stupid cheap. People thought, oh, we're never going back to oil. Cathie Wood said, oil's never going back over $30 or $40 a barrel, whatever she said. Great time to be buying when everybody thinks that oil is the worst thing in the world, even though it's the number one commodity. And whenever you swing in this ratio, you swing down and you come back, I mean, it's almost invariable that it will come back at some point. The timing of it may not be perfect. You may have to sit it for, some years. Like 86 through 88, that was a rough time, but you could accumulate for a very long time, and then it compressed all the way back down to below 10 in 1990. But we had this anomaly here, and everyone was underinvesting in oil. Everything, ESG movements, all those different things. And I thought that you just couldn't remove oil from our economy. And it wasn't just this ratio. We also had the commodity to stock ratio. do some crazy stuff. That's this ratio here, which when I was buying this, I was buying it on the turn. So I was buying it when in this area here is when I was buying things. I was buying it based off of what I thought was coming, which was an expansion phase or a larger demographic into home buying years. And they printed a bunch of money. So I use this information here and this large growth in money supply here to say, look, there's a high likelihood that inflation's coming. They printed this to the hilt there. This was printed and was being shown on this in June of 2020. So I know that the money was coming into the system. It was in the system. Now it takes about 18 months to 2 years to kind of work its way through. But that money came into the system. We had a ratio that was off the wall cheap in relationship to everything. And we also had the bottoming of the CRB to S&P 500. And this overall ratio is incredibly cheap. So what I did is I combined the CRB to S&P 500 ratio. I was looking at the money supply saying, hey, look, inflation's coming. And then I was looking at the gold to oil ratio. That was also massively cheap in an anomaly fashion. And then I started looking at the charts. So I was looking at SM Energy. And if I were to kind of zoom in here, oops. So if I were to zoom in here, get this dot out of there. Let me go to the dailies here real quick, guys. And what I was looking at was this chart here, where it's basically a lead-in pattern that I usually see. And then we kind of leaked off a little bit more and almost came back basically to where the level was. And that was your opportunity. I saw big buying pressure, small selling pressure. It was bottoming. We have a favorable ratio for oil. We have a favorable ratio for commodities in relationship to stocks, and looks like it was bottoming out. We had an M2 money supply that grew rapidly, and we were in an expansion phase of real estate. So I was buying these based off of chart patterns, and I was buying it based off of ratios and the changing market conditions in the market, which was going to revalue the price of all these things because inflation was coming. And I said in my earlier videos, you can go back and watch them, that inflation was going to increase interest rates. And the interest rates, if you look now, we'll look at TYX, the 30-year. You take a big long-term view, we have a major breakout. And what I was doing is I was buying the bottom of these rates here before they came up. So the key to making a lot of money is to buy something before the price tells you you are right. Before the fundamentals of, I'll say, the validation of fundamentals in a oil company. I was buying these oil companies when they looked like garbage. When they looked like garbage. And uranium and everything else. And that was the changing of the fundamentals, and I speculated on the price movement changing based off of the money supply, the expansionary phase of real estate. All of those things matter because I know that assets get priced differently under different market conditions, and this here is the validation of the differing of the market conditions. These interest rates are what change the value of stocks, and bonds are obviously being sold. So money's rotating. And I used all of those things to determine how to do it. And I'm still using that. And we have still changing market conditions, which are squeezing people out of bonds and squeezing people out of stocks eventually. And that money's going to rotate into something that's going to work, which will be commodities. And we can see that and validate that through our ratios that are changing in the commodity to S&P 500. That's how I'm validating it. It's a new paradigm where commodities will outperform was down here. And I bought it very early, and that's how you get rewarded massively. And I still think people will get rewarded massively in commodities. So I'm the one thing I kind of want to iterate here is I'm buying patterns, which is technical analysis. And the fundamentals are going to look bad at the bottom here. So I don't know how you could do this if you just did fundamentals. You have to have technicals. And I'm using ratios. I'm really relying on ratios because ratios tell you where the value is in the market. It tells you where the money is not. And you need the money to not be in the investment that you're in, and you want money to rotate into it eventually, increasing the valuations or prices of that sector. That's how you do it. There are still opportunities out there where things are lagging. And the way that most people look at it is they'll say, well, this is lagging. It's not going anywhere. And then their time frames are too short. What I do is I lengthen my time frames out and I buy things for a couple of years because sometimes certain assets stay down for a while. Then they start to take off. And then people will say, oh, I should have bought that. Well, you should buy it, accumulate it when it's cheap. And then you have to wait for the market and the money to rotate over. You have to wait for that to happen. So basically, I'll say it again, front-running money flows. I'm front-running where the money is going to flow. That is investing. And it's usually just a large pile of money that rotates around different assets, and you're just front-running that pile of money flow given the market conditions. So the money flows because market conditions are forcing it to flow. If they don't do anything, they lose money. And what they're going to do is they're going to chase performance. That's what these institutional investors do. That's what all these investors do. They just chase performance. So the question that you want to ask yourself and answer is, how do I accurately front-run money flows? Because that's how you make your money. Fundamentals, it doesn't have anything to do with fundamentals. A company can be making good money, very good money, and if your interest rates change on you, they could still make good money and their stock price still go down. It's a tough lesson. I learned the lesson, guys. I've learned all those lessons. I saw the last commodity bull market. I saw stocks go down in the early 2000s, and I've seen them go up based off a disinflationary period. And I think stocks will do well if we can figure out our commodity situation. But right now, commodities are so underpriced and their market balances are so jacked up. I don't know how they're going to make a ton of money. Their margins are going to squeeze in these companies that are consuming commodities, especially in copious amounts and especially in certain sectors. I mean, electric vehicles is going to be a rough. Renewables and electric vehicles are going to be rough because they're converting a bunch of minerals which are going to be short. How are you going to make money if all the stuff that you're going to sell is going to be short? It's going to be rough business, I think. It's going to be a rough business. Now, timing. People ask timing. When should I buy? When should I sell? Here's the U.S. monthly supply of houses. And historically, I know this cycle is a little bit different because they printed a bunch of money and handed it all out to people. But historically, last cycle, we had a housing boom in the mid-2000s. This is the mid-2000s here. Then in about 2005, we saw this increasing amounts of inventory, all the way above 10, 12, and this is where things blew out. So usually, the housing market's a big portion of the economy. There's a lot of people that get hired to build new homes when they're building new homes. And what was happening here is they built way too many homes. They had a bubble. They were giving loans out like they were free candy. And those loans were starting to go bust. And I don't show the stuff where they were going bust here. I'm just showing the U.S. monthly supply of houses, which is one good indicator. This is another thing you should layer in to your market conditions. This here can ruin your M2 money supply. It can all crash and come crashing down because this is your driver of credit growth. This is your driver of M2 money supply and the destruction of M2 money supply. If people are going to go bust and default on loans, that will destroy the M2 money supply, which is deflationary. So when this started to go up, we had what, 2007, 2005, you could ride it up to about 10 months, which is 2008, and then you got to bail somewhere in here. Now we're very low. If you were to look at our inventories, we are still incredibly low. That's about 3 months worth of inventory or so, maybe a little bit less than 3 months. So 3 months, if you were to look, we're below the lowest spot. We're at 3 months below the beginning of the bull market in housing still. And what I mean by 3 months, that's completed homes that you can actually buy. Now that can change and we can watch it, but I don't think it's going to change overnight. Even though it could go up fast like this, we would still see it and we could still be prepared, because when we get above, 8 months, we're starting to get into sell territory where the M2 money supply could start getting destroyed. That is if people are defaulting on their loans. We're not seeing any of those indications at that time. So we're still good to go long, and I don't think that this blowout recession that some people are predicting is necessarily going to happen across the board like it did in 2008. It very well could blow out the stock market. Why? Well, the stock market doesn't like rising interest rates. There's your rising interest rates. It's a paradigm shift. The reason the stock market is going down is because of these rates increasing. Now, rates increasing means that you've got too much money in the system. A crash usually has rates going down. So here's the crash right here. You saw the crash in June 2007 where rates started to weaken. And then July 08 and 08, it's like this thing's going to blow out to the downside and people run to safety in market crashes. And in 08, we also had expensive commodity to stock ratio, expensive oil to gold ratio. We had everything that was expensive. So there was no reason to really hold these assets. Here's the top right there. November 08, May of 08. It jumped up in one last move higher and then it all collapsed. That's your sell point, guys. The demographics also. So it's an alignment of all of these things. The demographics, the housing market with a whole bunch of inventory ratios that are expensive. Those are your sell signals. Your buy signals are everything opposite. A new demographic is coming into home buying years called the millennials. We're going to see interest rates increase. We're going to see all of these things. They're all interconnected. Everything's interconnected in this market. And someone also brought up that we should be looking at market capitalization. The thing I don't like about looking at this, and you can do it, it's not a big deal, but really what you're looking at is more or less the price of this company. Market cap is price. Does price tell you value? No, it doesn't. You need to get value. And market cap, 6 million market cap here, or 6 billion, I should say, 6 billion market cap is you're going to have to index that to how much money is in the system. There might be 100% more money here. So in order for a company to reach the same valuation as before, this same company, and I'm not talking to you, I'm just saying a company that has added a lot of value to its shareholders, the same company might be valued the same valuation of $6.5 billion at 2012. The valuation might be $600 billion because they've added value, the money supply, and the price of the commodity and the inflation in that commodity could go to levels that are far, far different than what they were today. So when I look at this, all you're looking at is the price of the company. You're not looking at the value. The value is where the price will eventually end up. And that's where people get everything messed up because they know the price of everything and the value of nothing. So I'm very reluctant to use market cap and try to compare market cap because this 6 billion back here is kind of an irrelevant number at this point. They've progressed. They had to have progressed something in this company to add value to shareholders. That's all I'm saying. Value is what you want to chase, not necessarily price. And this here, ratios tell you the value of assets versus assets given history. And that's what I teach on my website, is how to do all this and how to overlay all of it. And then you guys can ask me questions during the weekends and if you're doing it right or wrong and what my opinion is. I know I get some people they're asking, they'll learn technical analysis. We do trainings on technical analysis. We're going to do a training coming up, not this week, but next week. I'm going to schedule it. And what they're going to do is they're going to learn that technical analysis. They're going to try to apply it into a company. And they're going to be doing it with the tailwinds not being tailwinds. It's going to be a headwind. I'm looking for alignment. I'm looking for everything that's aligning in the favor of the investor to maximize the probability of success of that investment. That is what I do. So if you guys are interested in learning how to do this, the description link below, the Platinum membership, because the Platinum membership gives you interaction with me. It allows you to learn all of this stuff. I have tons of posts on all of this. And then there's the question and answer sessions every weekend that we do, that you can ask me questions directly. And what I'm trying to do is get this alignment of everything. And then I use technical analysis to validate it. And the way that I bought these bottoms is that I was speculating on the market conditions changing, which will revalue assets. And that's where the most amount of opportunity is in any market, is when everyone's thinking the past 40 years and you have a changing market condition that's going to revalue assets based off of the differing money flows in the markets. It's going to force people to change their habits and their ways because they're going to lose money. That's the biggest chance of success and the biggest chance of really outsized gains. So that's how I did it. That's what I used, is all of this information. It wasn't one chart. It wasn't two charts. It's the interconnectedness of human behavior with valuations and changing fundamentals in changing market conditions. That's it. If you guys want to learn that, I also do technical analysis training. We're going to do one not this week, but next week. I'll schedule it on the website for the Platinum members. Only the Platinum members. And if you want to attend those market condition or the question and answer sessions, I usually hold them on the weekends. I'll set it here shortly, which day it is and what time. And we can get together and we can do that. It's usually 7 a.m. Saturday, Mountain Standard Time, or 5 p.m. Sunday, Mountain Standard Time. All right, guys, that's what I've got for today. Hopefully you guys like the content. Give me a thumbs up. Subscribe to the channel. Subscribe to the website, Platinum membership below. It's definitely worth its weight. If I could do it and I had someone basically mentoring me about all of this, it's game over, guys. I'd make so much more money. I tied a lot of things together that I was missing when I was a new investor, and it took me a very long time to learn all this. So now I've got it all packaged up, and I think it works very well. All right, guys, we'll catch you next time. This is Finding Value.